Welcome back, everyone. So we are continuing now with the second session. In this session, we are going to look at Learning Unit 3, which is our depreciable assets. Now let's quickly look at what is the learning outcomes for the specific learning unit. So the first thing is you need to be able to apply the different methods of depreciation. Now we will discuss it shortly, but there are two methods of depreciation which we apply in accounting. So you need to be able to show a calculation using both of them. Then you need to make the necessary accounting entries for the depreciation. So now once you've done the calculation, how do we actually record it into our accounting records? So this generally takes place through our general journals. Then you record the entries of the depreciation in general ledger and general journal. Now those entries is accounted for in your general ledger account, your T account, and your general journal is how you bring them into your T account. And then you need to be able to explain what is the purpose of an asset register, so that we will discuss at a later stage, and then apply the 4 steps of assets disposal, so that we will look at next week, as well as how to prepare the disclosure in your financial statements. So for today, we are going to focus on the first 3 items or 3 learning outcomes. Now, let's quickly go back and just discuss what is depreciation, depreciable assets. So in the first semester, we talked about assets, we talked about non-current versus current assets. Now, a depreciable asset is a non-current asset. It means that asset is controlled by the entity and we are planning on using it or keeping it for more than 1 year, so more than 12 months. And it is as a result of a past event. So I either bought it or it was donated to me, whatever the case may be. And we expect to get some form of economic benefit from it. So whether I rent it out, for example, if it's a property, or whether it's a motor vehicle and I'm going to use it to do deliveries, I will get some form of benefit, which will generate some type of income for the business. Now, most of your non-current assets will fluctuate in value. Now, there's two types of fluctuations. The first one we call appreciation. So that's where it increases in value. Now, examples of that is, for example, real estate. It can be land. Those assets will generally increase in value over time because of how the economy works. Whereas we have other assets which will lose or decrease their value over time, and we call that depreciation. So they depreciate in value. Now, why do they lose their value? Is because as you use that asset, it actually becomes, the worth of it reduces. Now, an example of that is your car. Let's say you've purchased a car now. Today it's brand new, but in 2 or 3 years you won't get the same value. So it has lost its value because of the fact that you have used it to get from point A to point B. Now, if we talk about depreciation as such, we at year end do the calculation for your assets. So we depreciate your assets and we then go and adjust the value of the assets based on the depreciation calculated. Now, to adjust that value, we call that the carrying amount. Now, your carrying amount is your original cost of what that asset cost you, less your accumulated depreciation. Now, accumulated depreciation is the sum of all the depreciations for the period you've used it so far. So depreciation is calculated every year. It is an expense account. But to keep track of how much value has that item decreased by, we then accumulate it in an account which is accumulated depreciation. It's a negative asset account, and that is how we then keep track of what is the actual carrying value of that asset. So when we discuss the disclosure, you would actually show in the property plant and equipment note, you would show the original cost and you would show what is the amount that this asset has been reduced by, which we call the accumulated depreciation account, to show the carrying amount in your financial statements. And that carrying amount is what your asset is worth at that stage in time. Now we said there's two methods of depreciation. We get the straight line method. So that means the depreciation charge will be exactly the same for every year. So we work it out on the cost at a fixed percentage. Whereas the diminishing balance method is we work out the depreciation on the carrying amount or the opening carrying amount for that year multiplied by the percentage we've calculated. So we say as the asset is used, the amount of value it will lose over the period will decrease the older it is. So initially you would lose quite a lot of value, but the older it gets, the smaller the depreciation amount. Whereas with the straight line method, we say it doesn't matter which year it is, it will lose the same amount of depreciation per year. Now, as an entity, you are allowed to select, we call it accounting policy, which method you want to use to reduce the value of your assets. Now, you can either do the straight line method or the diminishing balance method, but you need to motivate why you feel the one is better than the other one. Okay, so that will all depend on how you use the asset and what type of asset it is, what method you would think is most appropriate. Now let's look at the different methods by using a practical example. So let's say you bought this little motor vehicle for 200,000 on the 1st of January 2020. Okay, so that's last year. We tell you we depreciate this motor vehicle at 25% per annum. Now, 25% per annum is equivalent to over 4 years. Okay, so how do I work out? It's 4 years. You take the 100%, divide by 25, shows you 4 years. Then we tell you our year end is 31st of December. Now to work out the annual depreciation using the straight line method, so it's a fixed amount per year, it's exactly the same. For year one, we say our year starts 1st of January 2020 up to 31st of December 2020. We would take the 200,000, we would multiply it with that 25% that was provided to us, and it would be 50,000. In year two, you would do exactly the same calculation as well as year three and year four. Okay, now let me ask you a question. Let's say I've only bought this car in the middle of the year, so 1st of July. Do you think I would have to adjust my depreciation amount? Yes or no? So let's say instead of buying the car on the 1st of Jan, I bought it 1st of July. Will it change the amount of depreciation for the year? So Mabali says yes. Anyone else? Donovan also says yes. Okay, now with depreciation, if I purchased it during the year, so I haven't used that asset for an entire 12-month period, you would have to go adjust that depreciation of 50,000 to reflect the actual amount of months you've used it. So if I've purchased it in July, I would actually adjust it to 25%, which is half of it, because I've only used it for 6 months. Okay, so that is important to note. When we do a physical question, we'll recap it again. Let's look at our next method. This is now the diminishing balance method. So now instead of doing depreciation exactly the same amount per year, we work out the depreciation from year two onwards based on the carrying amount. Now the carrying amount, let's just recap that again, is the original cost, so what you paid for it initially, less the depreciation charge that you've already deducted up to that stage, which we call the accumulated depreciation. Okay, so let's use the same scenario. We said we bought the car, 200,000. The depreciation rate was 25% per annum. But in this case, we're using the diminishing or reducing balance method. So in year one, the depreciation charge would be exactly the same, irrespective of which method you do. From year two onwards is where it will change. Now, what you can see is in year two, we take the cost of 200,000, we deduct the depreciation up to that stage. Now, because we've only had 1 year's depreciation before that, it is equivalent to the prior year's depreciation of 50,000. If it was more than 1 year, you would have added all the years' depreciation together to get an accumulated amount. Okay, so a total depreciation. So we take the 200,000 less the 50,000, which gives us a carrying amount of 150. We multiply that with 25%. So now the depreciation for that year based on this method is only 37,500 instead of the 50,000 based on the straight line method. Now, if we use this method, what it would mean is we would actually use that asset for a longer period. And we expect when we sell it to generally get an amount back. Whereas with the other method, we say after 4 years, that car is worth nothing, which is not necessarily the case. Okay, depending on how you use it. Now, before I move on, do you have any questions on the two types or the two methods of depreciation we've discussed? If you've got a question, just type it in the chat function, or you can just pick up your mic and just ask me if there's anything that you're unsure about. Yes, Donovan.
Hey ma'am, what are the various advantages of either system?
Okay, so what's the advantages? Okay, so with the straight line method, what is good about that one is it's a simplistic method. It is not that difficult to work it out, so it is not that difficult to keep track of it. So a lot of companies actually prefer the straight line method just because it is easier to do. The one with the diminishing value, what is better with that one is you would actually spread the cost over a longer period of time, and it would be more in line with how you use it. Okay, so that is, for example, where someone is planning on using a car, for example, for 4 or 5 years, actually more, for 7 years, they would rather prefer doing the diminishing value because they say, okay, as the car gets older, it won't lose its value as quickly, but then they would generally have, we call it a residual value. So it's the value we will trade it in for or sell it at a specific date and time. So they will align it more to what you would see in the market if I trade in a car. Whereas with the straight line, we're saying, okay, after year 4, that asset is worth nothing. We would generally use that more for specialized type assets. For example, in your mining or construction industry, where after a number of years, you have to refurbish that item before you can use it again. So there we would say, okay, because we will use it for more or less the same type of projects, but it would be charged onto different clients. We would actually want the expenses to come through at a similar rate using the straight line method. So that is basically the difference. It all depends on the business, which they prefer. And then there's also a tax implication. So from a tax point of view, you get wear and tear. That is how SARS determines how you depreciate an asset versus how you do it for accounting purposes. Now, what a lot of people do is they prefer to align it with SARS so that there's not any differences, because otherwise you have another accounting standard, but this is third year level, which creates a deferred tax asset or deferred tax liability, which means I will have a tax benefit in the future where I can deduct more expenses, or I will have a tax liability where I actually have to pay more money over. So what a lot of people do is they actually prefer sticking very similar to SARS to make sure that they don't have to implement that accounting standard, because it can be a bit hairy at times. So that's one thing, one of the benefits why straight line method is better, because SARS actually follows a straight line method, and it's easier, but it is not necessarily the most accurate method of how you're going to use the assets, whereas the diminishing balance is a better reflection of how certain assets would lose their value, which would give your shareholders a better reflection of how your assets values are decreasing over a period of time. So there's different reasons why people use the different ones. There's not an incorrect one per se. It's just based on management and shareholders' perception, they would prefer the one above the other one. Okay. So let's talk about these methods now. So our annual depreciation, so that is the depreciation for that specific year. We determine that by using the estimating the asset useful life. Now, in the previous example, we said the depreciation rate was 25%. Now, if we convert that to a useful life, it means that car's useful life, according to us, is 4 years. Okay, now in a question, they can either give you a percentage or a useful life to work out your depreciation. Now, the useful life is how many years do I estimate I'm going to use that asset for. Now, in a question, they can also, at the end of the year, decide that the initial useful life period that we've estimated has now changed based on industry norms and additional information. So then you have to go adjust it. Then you would go rework out your accumulated depreciation and then do additional adjustment. But for your scenario this year, we're not going to change the useful lives, but just be aware of the fact that in practice, the useful lives do change. You have to assess them every year to make sure they are still accurate based on what's happening in your industry, in your business. A residual value is how much money do I expect to get from that asset at the end of its useful life, either by selling it, by trading it in. So how much money do I think that asset would be worth? If there is a residual value in the question, you need to deduct it from the initial cost before you work out the depreciation. Now, the reason we do that is because the carrying amount of that asset needs to be equivalent to your residual value at the end of its useful life, because that's what you expect you will get for it when you trade it in or you sell it. Okay, so we do not write off that additional amount. So if we look at the example here, I said we assumed the asset was 380,000. We expect that the residual value, so the value we would get for the asset at the end of its useful life, is 20,000, and we expect it has an economic life of 6 years. So I expect to use it for 6 years. Then the depreciation would be determined. I take the cost, I deduct the residual value of 20,000. So my actual depreciable amount is only 360. I divide that by 6 years. That gives me 60,000 per year. Okay, before we move on, do you guys understand the useful life concept? Do you understand the residual value concept? If you've got a question in the chat function, or just raise your hand. Donovan, do you have another question? I see your hand still up. If you're okay with it, if you're okay with the concept of useful life and residual value, just give me a thumbs up or smiley face. If you've got a question, please just type it in the chat function for me. Okay, so I see one person is at least happy with the concepts. What about the rest of you? Okay, excellent. So let's move on then. Okay, now the next step is once we've done the calculation, now we have to actually account for it in our accounting records. So now we have to go do our general journal, which then goes into our general ledger accounts. So to account for depreciation, we say depreciation is an expense, so we will always debit it. So when we discussed the accounting equation in semester 1, we said that expenses are always increased on the debit side. Okay, so that's why we debit depreciation, because depreciation is an expense account, and we credit the accumulated depreciation, but this is a negative asset account, so it will have a credit balance. Now, the reason it has a credit balance is because we want to show what the actual carrying amount is. And the initial cost will always be a debit for our asset account. So to reflect the correct carrying amount, we now have to make this a negative asset value to show the correct debit net amount. Okay, so this is something you need to remember, that accumulated depreciation is an asset account, but this is the exception to the rule, where it will have a credit balance and not a debit balance. Okay, so this is just something you need to study. This is a little exception to the rule. Okay, and remember accumulated depreciation. Let's say you sit there in that test and you can't remember it's a negative asset account. What you think about is, okay, accumulated depreciation would reduce my asset. My asset is always a debit when I initially bring it in. So how do I reduce an asset? I credit it. Then you know it's a credit balance. Okay, so that's how you think about it. And then in our statement of financial position, we only show the carrying amount. So we show the net amount of the cost and accumulated depreciation. We do not show it separately in our statement of financial position. Okay. Now let's do a class activity to capture what, or do what we've just discussed now. So in your textbooks on page 65, we've got question 3.1. Now, it's Nakula Stores bought furniture for 67,200 on 1 July 2007. It was decided to depreciate the furniture at 20% per annum according to the straight line method. So it's straight line, and they said ignore VAT. Now, because of the fact that they said ignore VAT, you don't have to worry about it. If we had included VAT, you first have to take out the VAT out of the initial cost price before you start doing the depreciation. And then they tell you show all your workings. Now what they want you to do is you need to prepare the depreciation and accumulated depreciation accounts for 31 December 2007 and 2008. So you need to work out what is the depreciation for year 1, what is the depreciation for year 2, and the accumulated depreciation would be the depreciation in year 1, and then in year 2 would be year 1 and year 2's depreciation. And then the last step, or the second thing they want you, is show the depreciation adjustments and closing transfers. So this links into Learning Unit 9 in the first semester, where we did year-end procedures. That is what it links into. So now you have to close it off. So remember, when you close off an account, your income statement or your profit and loss account, you take it to your profit and loss to work out what is your net profit at the end of the year. Okay, so that is what that means. So what I want you to do is I'm going to give you 10 minutes to work out the depreciation so long for me and the accumulated depreciation. and then account for that in the general ledger, and then we'll discuss the closing transfer entries together to recap what we've done in the first semester. If you've got questions, please just type it in the chat function, or you can just put on your mic.